and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, February 21st, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we have futures that are pointing lower. We've got Dow futures down close to 300 points now, down 280 points. S&P 500 futures down 29.5. NASDAQ futures down 118. That also is about 1% on the NASDAQ, which is just a little bit higher than the Dow and the S&P. Crude oil, $76.77 a barrel. That's up 43 cents, a little more than 1.5%. And the U.S. 10-year Treasury yield up 5 basis points this morning, 3.88%. I'm watching that 3.90% area pretty closely, 390, 391 right in there. Key short-term resistance. We'll take a look at that chart in just a little bit. First, before I get into any of that, though, let's run down today's agenda. So I'm going to start off with the daily market recap, talking technically, little seasonality. Then we're going to do a new segment, good stock versus bad stock, really just to show you a little bit about how I use relative strength. I think you'll get a pretty good sense taking a look at some of these charts. Earnings spotlight, and then we will wrap up with the 3 you must see. For those of you who are new, if you go over to earningsbeats.com, earningsbeats, plural, both, and just scroll down. Go to earningsbeats.com, scroll down, and there will be an area you can sign up for a free newsletter. Name, email address, hit that subscribe button. That's all it takes. 3 times a week, Monday, Wednesday, Friday. Try to get it out around 8:30 in the morning. Sometimes it can be a little bit later, but generally we do try to get it out around 8:30 in the morning. And just, it's a very quick read, couple paragraphs and a chart. We try to make it very educational, things that we look at in the market, like earnings, like gaps, candlesticks, relative strength, those types of things. So if you just like something to kind of wake up in the morning with your cup of coffee, whatever, I think the Earnings Beats Digest is a good way to go. And again, it is completely free, no credit card required. You can unsubscribe at any time. We'd love to have you. And also, we do free events from time to time. And when we do those, we reach out to our Earnings Beats Digest community. So anybody who has signed up and is part of our community will be invited to any of our free events. And they tend to be very valuable educational events that we do hold for our community. All right, let's move on. And what happened to close out last week? Well, for us at Earnings Beats, we selected new portfolios. That was one big thing. Every 90 days, we put 10 equal weighted stocks in each of our portfolios. And so we did that for the next 3 months. We had the session last Thursday evening, but everything became official as of the close on Friday. So any stocks that we put in would be purchased, technically purchased, quote unquote, at 4 o'clock Friday afternoon. And those that we sold would have been sold at those closing prices as well. Both our key portfolios are aggressive portfolios, which are our model and our aggressive. They both beat the S&P 500 again last quarter. And we're hopeful this quarter. I do think the next few weeks could be a little difficult in the market, and if they are, probably my guess is that our portfolios get off to maybe a little bit of a rough start, but that's typical for market behavior, and I'm going to talk about that a little bit when I get to seasonality. But just taking a look at what happened, or how we closed out last week, you see the Dow Jones Industrial Average finished up 130 points. S&P though down 11, NASDAQ down 68, mid caps down 4, small caps up 1. So bifurcated action, not really a lot of anything going on. We did see the S&P 500 though close just slightly beneath its 20-day EMA, and with today's morning weakness or overnight futures, it does look like we will be further below the 20-day at the open, and we'll see if the market comes back. That'll be a great short-term move to rally back, but if not, then we'll have to look at some things to the downside. Certainly the 50-day moving average, which is at 39.77, comes into play, along with just that psychological level at 4,000. I mean, we've been going up and down above it enough where I don't think 4,000 is really that big a deal anymore. But I'd be watching the 50-day moving average and some key short-term price support levels, which we'll look at in just a minute. From a sector perspective, staples, utilities, healthcare, all three defensive groups leading on Friday. So we're seeing a little rotation that kind of, leads me right into the seasonality discussion that I'm going to have with you in just a couple seconds here. But defensive groups tend to do better, especially when you get into the month of March. It's an interesting fact about how the market tends to trade, even during a secular bull market. The third month of each quarter tends to be a little weaker, and I'll show you that in just a minute. Energy was down. You can see down more than 3.5%. Went back down and closed below $85, and in my opinion, broke this uptrend line in what would have been a very nice ascending triangle. So I was looking for that pattern to execute, and an execution above 93, 94 would have had a target of 105, but that didn't happen. And that's why it's really important that when you see patterns, you make sure they confirm that they execute. This one did not. It broke down. Doesn't mean necessarily that we're going a lot lower, but what it does do, in my opinion, is it opens up the prior low. So instead of having rising lows with equal highs, now what I would be looking for is equal highs and equal lows. So I do think to the downside, $82 now comes into play on energy. And that sideways rectangular pattern can still be very bullish after this uptrend. But clearly that would not execute, and it would be negated if we see a close back down below about $82. So that's the next level to watch there. Technology, also not a very good day, lost 1.25%. Went back down just above its 20-day moving average. So with futures weak today, money rotating maybe a little bit more defensively. Some of these areas like technology, in my opinion, may lose that 20-day moving average. That's also price support, by the way. Right about 139 there is price support on the technology sector ETF. So 139 is not only at the 20-day, but also you got some price support there. So if we do gap down below it and we trade down today, then I would say the next step for technology would be down potentially at that 50-day moving average. And that would be a drop of about $7, which would be, that's what, 5% from here. So it does look like the market is set up for a pullback. We'll see whether or not the bears get control and if things follow through. But short term, I am a little bit more cautious. I've been expressing that with members. Last week was options expiration. And we're always, whenever you have a nice move, when you see technology going up like this into option expiration week, you tend to see weakness toward the end of the week and then even into the early part of the next week. The worst day for the stock market since 1950 has been the day after monthly options expire. Usually Monday, but since we had a holiday, it's Tuesday. So am I shocked that we have futures down? No, I'm not. Historically, this is what the market typically does. So I do, and if you say, well, why would this have anything to do with options expiration, right? That was last week. That ended on Friday. Well, anyone who exercised options, if you were long a stock or, you had calls in a stock and the strike price was well below where we finished on Friday, you had the option to exercise. And if you exercise and buy the stock at that strike price, guess what the market maker does? The market maker shorts that stock. So basically borrows to provide that stock to you that you're buying. So market makers still have an interest, a financial interest in seeing prices go lower when you've got a lot of in-the-money call premium like we did last week. So in my opinion, that's why you get follow through into the early part of the following week relating to options. And that's also why historically the 19th to the 25th is the worst time of a calendar month. 19th to the 25th, going back to 1950 on the S&P 500, the annualized return for that week, and you might say, oh, it's just a week. Well, yeah, it's just a week, but it's a week of every month of every year for 73 years. It's a week out of a month, which is what, roughly 25% of that month? So it's roughly 25% of all trading days since 1950. Well, that equates into about 18 years worth of data. The annualized return for the 19th to the 25th is minus 7 to 8%, somewhere in that range. I don't have the number right off the top of my head here. Actually, I probably do have the number right off the top of my head. Hold on one second. I can give you the number. So the 19th to the 25th, let me tell you how many trading days this covers. All right, 19th to the 25th covers 4,162 trading days since 1950. And there's 253 trading days in a year. So let me just do this quick math. 16 years, 16 and a half years worth of data. Minus 7.62%. The annualized return of every single trading day that falls between the between the 18th and the 26th, from the 19th to the 25th. Minus 7.62. Imagine going through a 16 and a half year period in the stock market where I told you the market was going to go down 7.62% on average every year. How excited would you be to trade in the stock market? Probably not very excited, at least not on the long side. Might be excited on the short side. That's the equivalent. I mean, and this is in the middle of a 100-year stock market that's been going up, 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 up since the 1930s. We go through periods where we go down, but for the most part, from left to right, market's gone up for 90 years. And yet, there's this 7-day period right in the middle of every single month that yields minus 7.62% annualized since 1950. So it's a real deal. Today, it falls right in the middle of that period. This is February 21st, right in the 19th to the 25th. It's the Monday after options expire. This is not news. They don't talk about it. The most media outlets don't tell you anything about it, probably because the firms that sponsor them make a lot of money from options expiring. Do you think they want to educate you? Probably not. Not if it's going to cost them money. They don't want the masses to know about it. But I'm telling you from history, does it happen every month? Of course not. First of all, the market goes down sometimes in the middle of the month, and you have in the money puts rather than in the money calls. That would actually make the market makers have a financial interest for the prices to go up from the 19th to the 25th. Anyway, getting sidetracked here, but it is good information. I want to make sure everyone is aware of that. Moving on to the 10-year Treasury yield. So we talked about 5 basis points that it's up today. We're back up 388 or so. Right here, I mean, I've been talking about the longer-term trend here in the 10-year Treasury yield remains higher. Higher high, higher low, higher high. So far, higher low. If we break out above that level, that obviously would extend and confirm that the longer-term uptrend in Treasury yields is alive and kicking. Now, since this high and this low are the keys, what we do in between here is kind of important. So this is an intermediate low or short-term low, and we basically have a double bottom. And then we have this intermediate high in between the two bottoms, which is fairly significant technically in the short term. And that came in at 3.89 there. That high is 3.905. 3.905. We hit a high on Friday of 3.90. Pretty close. And this whole time, even after when we were down here, I kept saying the big level is 390. I mean, sure, getting back up above the moving average is kind of critical, but if you're sideways consolidating, moving averages don't mean anything. When you're in a trendless market, I mean, you just go up and down above these moving averages like they're not there. And that's what we're in right now. We break above 3.905 and we're close. Then I think the bears potentially have some ammunition to take this market lower. And I've told members, I think in this, between now and March, I think the word to use for the market is vulnerable. Short term, I think the market is vulnerable. History tells us to be careful from now through the end of March. Got a couple bullish periods in there, but for the most part, the market tends to be a little bearish, or at least very cautious, very defensive oriented. So you've got to be aware of history. And I think the market's setting up for us to see a little bit of either sideways action, maybe a little bit of selling. But I would not be shocked to see the S&P 500 move as low as 3,800. I wouldn't be shocked. I'm not calling for it. It's really hard to call the market day to day or week to week. I mean, I feel like I'm much. I think it's much easier to call the bigger tops and bottoms because there are usually a lot of signals. In the short term, I mean, there's so much money at stake. The market's so inefficient in the short term. Trying to figure out today, is it going to finish lower? I mean, obviously we've got futures down. Is it going to finish down? Is it going to rally back? Those are really hard questions to answer. I mean, the history since June of last year has basically been that when the market goes down, it tends to come back later in the day. But I do think as we move into later February and into March, some of that may change. We may actually see a little bit more selling. So keep that in mind as we move forward. And I'll show you why here in just a couple minutes. S&P 500, nice kick save right there. Nice little hammer or doji, or dragonfly doji if you're a candlestick fan. But right there at the 20-day moving average, holding the prior candle body low. So that was good. Short term, that looks pretty good. NASDAQ, but it did finish a point below the 20-day moving average, by the way. The NASDAQ did even better because it held back above the 20 at the close. But you can see here that we've got some price support that comes in maybe around 12,150. We got down to 12,233 here, a little bit lower than that a week and a half ago. So that would be an area to watch, maybe 12,150. But I do think it's possible that we make another move back down here to the 50-day moving average. One reason I say that is if you look at the XLK, we actually had higher closes in here. I don't usually like to use a line chart, but the one time a line chart comes in handy because you're looking at this and you're like, is this a negative divergence? Lower PPO, are prices higher? Remember, PPOs, MACDs, they're all based on closing prices, not intraday prices, closing prices. So if you're going to see whether prices are higher or lower, you really should look at closing prices. And that's where you have one advantage with a line chart. So I just go down here and get the solid line, thick chart, and this will tell me where have I closed. Clearly, I have closed higher on technology. So higher closes, slightly lower PPO. This is another short-term argument that says maybe we're going to pause here. Maybe we get a 50-day test. So it's just one more thing lining up. All right. Let's move on. And want to talk about seasonality. So I wrote an article yesterday over at StockCharts and just talked about an industry group as part of our portfolio process, picking the 10 equal weighted stocks. I go through a process, what I call my war room. I just put an Excel spreadsheet together and I look at every industry group, every sector. I look at the weekly PPOs. I look at the seasonality for the next 3 months relative to the S&P 500. And I just start to get a sense of which areas of the market do I feel most comfortable about over the next 3 months. Now, if it was over the next month, I probably would choose things a little differently because the next month tends to favor defensive-oriented sectors and industry groups. But if you get into April and May tend to be really bullish months for aggressive areas of the market. That's why personally, I think the market is vulnerable right now. I think we're going to fly in April. I might be wrong. I believe we're going to fly into the next earnings season, but we shall see. I think we might have a little bit more resolution in terms of the inflation data. We got another couple months, month and a half of inflation data. Got a couple Fed meetings coming up here fairly near term. So we've got things that I think will maybe start, the water might start getting a little clearer as we look at it. Anyway, when I look at the next 3 months, this was probably the strongest group. Actually, I'm not going to say probably. This is the strongest seasonal group. I went back 11 years, which takes us back to 2013. That's when the S&P 500 broke out above the 2000 and 2007 highs at around 1550 or 1570, whatever it was. So this was when the secular bull market was confirmed and it began. So I'm looking since the secular bull market began in 2013. And since that time, if you look from January through July, look at how often specialty finance outperforms the S&P. And every one of these, its average outperformance versus the S&P 500 is positive in every case except June, where it's flat. January averages outperforming 1.9%. February 1.3%, March 1.7%, April 1.6%, May 2.1%, July 2.6%. And then second half of the year, or last 5 months of the year, not so much. You can see it actually, we have negative, what's that, minus 3.1, 1.9, minus 1.6 versus the S&P the last 5 months of the year. So specialty finance is kind of set up here to do well historically. And I think also the chart looks pretty good. I mean, here I put this dotted line in, this vertical dotted line, right at the beginning of the year, because January is when we start to see relative strength. And look at this, almost right on cue. We started seeing relative strength. Specialty finance relative to the S&P 500. We got an uptrend. Higher high, higher low, higher high. That's an uptrend. Now, could be within the confines of a longer-term downtrend. And if you're bearish and you believe that, that's fine. You could call this an ABC. I'm not really believing that. Obviously, charts, everybody interprets them differently. I have a lot of signals that I use as well. I believe the market goes higher. So I think specialty finance will do well. But this is a group that I think we need to be at least considering. All right. All right, that was just another chart of the specialty finance. I wanted to show you utilities. So I compare utilities to the S&P 500, also going back 11 years. So this is during the secular bull market advance since 2013. Look at March. Well, that kind of stands out. It outperforms the S&P 500. Utilities outperform the S&P 500 90% of Marches since 2013. And they average outperforming by 3 percentage points. But at the beginning of the show, I said defensive groups tend to outperform in the third calendar month of every quarter. So that would be March, June, September, and December, right? So if you take these and add them up, 3.0, June is minus 0.3, so now we're at 2.7. Add 0.2, that's 2.9. And add 1.6, that's 4.5. Utilities, on average, over the last 11 years, have outperformed the S&P 500 by 4.5 percentage points in the third quarter, or excuse me, the third month of every quarter. It's after earnings season, folks. Once earnings are out of the way and the market has nothing more to trade on, those aggressive areas tend to take a back seat, and you tend to start seeing the defensive stocks come to the forefront for a period of time. Until when? Until you get into April and you start looking more at earnings season again. Then things pick back up in other areas, aggressive areas. But so that's 4.5% taking the third month. How about if we take the first month of every quarter? 0.8 minus 0.4, so we're back to plus 4, plus 0.4. July, minus 8, now we're at minus 0.4. And then October, plus 0.8, now we're back to plus 0.4. So the first month of the quarter, it's slightly above the S&P 500. The last quarter, it's way above the S&P 500. So what do you think happens during the second month? Look at this, minus 1.5. May, minus 0.8. That's minus 2.3 if you add those two together. So minus 2.3. August, plus 1, so that's minus 2.2. And November, minus 3. That's minus 5.2. So the first month is relatively flat. The second month, you want to be out of utilities. And the third month, you want to be in utilities. That's how utilities work. That's how most of the defensive areas work. Anyway, I thought it was interesting. I wanted to show you that. Let's move on to good stock versus bad stock. So I'm going to just do this kind of quickly here, but this is the footwear group. And I'm going to show you a bad one. Stephen Madden, SHOO, SHOO. Look at the relative. This is the stock relative to its peers. It just hit a 52-week low at the beginning of the year. Overall, lower lows and lower highs. It's clearly relatively weak versus its footwear peers. Here's the good stock, Crocs. Crocs, relative to its peers, look at this. If you're a momentum trader or even a swing trader, do you want to be in Crocs or do you want to be in Stephen Madden? I can give you my answer. How about semiconductors? Let's look at a good stock NVIDIA. Look at the relative strength, starting to soar again. Last 5 or 6 months, really strong. Bad stock, how about Intel? Look at Intel relative to its peers going down. Now, you might look sometimes and say, well, it's trying to break out, but it's in a great group. Now, I do think there's hope here for Intel because I like that AD line taking off, but it needs to make this breakout first. Then maybe we'll see relative strength. How about software? Good stock. FICO, Fair Isaac and Company. AD line soaring, price action great. Look at the relative strength versus software. Right near 52-week high. It's been going up since back in May. Bad stock, Bill.com. Look at the relative weakness sitting down at a 52-week low relative to software. Last one I have for you, specialty retail. I'll give you the bad stock, Dollar General. Dollar General started to downtrend. Look down here. Look at the relative weakness. It's been going down since July. So it's just not performing well relative to its peers. Good stock, Alta. Alta, great looking chart. Look at the relative strength back near 52-week high. That's all about relative strength, folks. It's really simple. It's all about relative strength. Let's move on to the earnings spotlight. Got a couple I want to show you real quick here. Walmart came out with really good numbers. They beat on their revenues. They beat on their bottom line, $1.71 versus $1.52. And if we pull up pre-market, now keep in mind futures are red. Walmart down 2.83%. Still in this range, though, I would say 142.30. I would be watching these lows right in here, maybe closer to 137.5, 138. If it starts to trade down below that, especially closes below that, I'd be careful. Otherwise, I would expect Walmart to hold that level. The other one I wanted to show you is Home Depot. Home Depot down 4% this morning. It does look like it is going to break down below this area of support, 305.40. It really needs to bounce from the opening gap. That would not be a good look there. And they did beat on their bottom line. I did not see revenues, but I saw they beat on their bottom line, $3.30 versus $3.27. All right, let's move on to the 3 you must see. And I have to do this fairly quickly here. Well, the first one is Deere. So I wanted to find my list here. Okay, here we go. So here's Deere. I like this. It was in a downtrend. I think it's broken the downtrend. You could even draw like a little wedge there. I like this breakout here. Big volume with earnings. I like it, but I think any kind of a pullback back to this open at 419 is what I'd be looking for there. CPB, I was talking about some defensive areas of the market. Here's one that broke out to its highest close in the last month. If money rotates more defensively, I think Campbell could be a winner here over the next 30 days or so. And then Amgen in the defensive area went back to put in this double bottom. If this holds, I think we're good. I could see Amgen maybe making a run up for the 50-day moving average. That's it for me. Everybody have a great day, and I will be back tomorrow over at Earnings Beats for your next Trading Places Live. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.